Hi everyone, this is Victor, co-founder of The Fifth Person. Here at Fifth Person, we help retail investors to look for great businesses, be it for dividend or capital gain. My job is to help them to identify these businesses and hopefully help them to grow their wealth and make more money safely and consistently over time. And today we're going to be covering on how to know when is the best time to buy. So before we move on to the main topic, to know when is the best time to buy, you need to understand this valuation matrix. So basically, the first matrix that you need to know is the price to earnings ratio. So what is this price to earnings ratio? In short, we call it the P ratio. It's a valuation matrix used to value companies. So the formula is basically very simple. You just need to take the price of the company divided by the earnings of the company. Okay, so that will give you the PE ratio. And if they tell you that you have the P ratio of 10 times, it means that if you buy the company for $10 and the company is making $1 in earnings, it takes you 10 years to break even your initial investment. So basically, the easy part in general is that the lower the P ratio, the cheaper the valuation, the higher the P ratio, the more expensive the valuation. So when it comes to valuing a company, you use the P ratio. But when you want to value the market itself, right, the index, the STI index, the Hang Seng Index, the S&P 500 index, you also use the P ratio. And the P ratio can tell you how expensive and how cheap the index is. And this is what we call the market PE. Okay, so we base on the market PE and we track the valuation of the market, because if the market PE is low, most of the other stocks will also become low. And if the market PE is very high, most of the other stocks valuation also will be high. So based on the market valuation, right, you're able to know when is the best time to buy or even sell a company. But in today's, we're going to talk about when is the best time to buy. So basically, the stock markets, right, or the index, right, work in a very cyclical manner, like this. So you have your trough and you have your peak. And when the market valuation or the market is at the trough, right, the market PE, right, is usually low. Low market PE. And when the market is at the peak, right, they usually have a high market PE. So when the market PE is at the low, right, usually you can realize, right, the market valuation at this point of time, right, is actually less than 10 times. And the market at the high, right, the valuation at the point of time is 20 plus times. Okay, more than 20 times. And on average, the index average, right, the market PE average, right, is actually 15 times. So this is the range that you want to look at. And what you realize is that during the low market PE, right, the investor sentiments are usually very pessimistic. And when the high market PE range, right, the investor sentiments are usually very optimistic. So that's why a lot of the stocks are trading very high. But when is the best time to buy? Is of course when the market PE is low. Because when the market PE is low, this is what we call opportunity. Okay, opportunity. Why I say there's opportunity when the market is low is because when the market in general, the valuation is low, right, overall the sentiments, right, all the other companies outside the index, right, generally their valuation also low. So it gives you ample opportunity to look for undervalued companies. And when the market P is very high, right, there's very limited number of companies that you can look at because all of them are traded at very high valuation. So let me give you an example. So during the dot-com crisis or before the dot-com crisis, okay, the valuation of the market at the point of time before they crashed, right, was actually more than 30 times. A lot of the companies, right, they are not even making money, are traded at very high P multiples. Then after you look at trade war. Before trade war happens, right, before the trade war happens, the market P at the point of time was actually about 21 times, more than 21 times. So at that point of time, I can't find any opportunity to invest in the US market because their valuation is generally very high. But after the trade war, I think the US market have fallen to almost like I think 16 times, very close to the average. And some of the companies actually presented some opportunity for me to look into them. So I went to purchase some US company at that point of time when the trade war happens. And also, if you look at the 2015, 2016 China stock market crash and oil price crisis, right? At that point of time, right, when the oil price and the China stock market crashed and it came tumbling down, right, double dipping down all the way until January 2016, right? The valuation of the Hang Seng, which is the Hong Kong index, was actually less than 10 times. And it was very, very cheap. And if I bought during that time, since then you have raised. Then after that, the trade war happened. Again, another opportunity in December 2018, the Hang Seng Index actually dropped less than 10 times again. And it gave opportunity for investors to go in to either look in the Hang Seng Index or look in the stocks inside the Hong Kong market itself. And since then, from December 2018 till now, the market has recovered. So this is what we call opportunity to look at when the market P is low. So next time, remember when you want to buy into any companies or you want to start looking for ideas, start to look at what's the valuation of the market. If you know that the US market is cheap, then you go in the US market. If you know that the Hong Kong market is cheap, you go to the Hong Kong market. That's where you can find ideas very fast and you know when is the best time to even buy into a company. So I hope you find this video useful. If you know somebody else who can benefit from this video, please share it with them. And once again, this is Victor from 5%.com. Thank you for watching and have a great day.